Hi, everyone. My name is Allie Johnson, and I'll be moderating today's session. I'll begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our guest speaker, Richard Todd, who is Vice President and Business Community Manager at City National Bank. He'll introduce himself and take us through his presentation on what lenders look for in your loan application. Please feel free to ask questions using the Q&A function. We'll respond to them as we go along. For any questions that we can't respond to in this webinar, we're happy to address them through our no-cost one-on-one services or connect you with resources that can help. We'll share a recording of this webinar as part of our follow-up email. So what is the Capital Pathways program? It's a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Businesses and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We'll start with a program overview, then go through the program eligibility, and finish up with an outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. This matters because businesses that are less prepared can often self-select out or fail on loan applications. Early failures correlate to a lack of adequate capital, and high-cost alternatives often don't build long-term capacity. To put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, only 20 to 30% of those who apply actually get their loans approved. To help address this challenge, Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Who's eligible? Very small businesses and nonprofits at any stage who face challenges accessing traditional financing. The services we provide include guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit building advising. We start with a self-assessment that pinpoints your business's key gaps so we can connect you with tailored resources, either through our Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we partner with a law firm who can help with more complex topics related to business registration, trademarks, and contracts and agreement reviews. We also offer financial webinars on topics including financial basics, financial statement preparation, and QuickBooks training. Our one-on-one tailored support covers areas such as business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, as well as loan readiness and lender preparation. Excuse me. These loan application readiness services include both webinars and one-on-one individualized support. These webinars cover topics such as today's, which is what lenders look for in loan applications, as well as interactive mock loan interviews, SBA loan options, and sample application analyses. We also have a partnership with a lender that provides one-on-one support to those looking for capital. Additionally, and finally, our credit building advisor will help you review and interpret your credit reports as part of building an individualized credit improvement plan to strengthen your credit and help you qualify for better financing terms and options. If you're interested in getting started, you can reach out to us through our website at virginiasbdc.org/programs/capital pathways, or you can reach out to me directly at ajohn216@gmu.edu. I'll share my email and our website link in the chat for all of you to have. Alrighty, so now we're over to introductions. As mentioned before, my name is Allie Johnson. I'm today's web moderator and serve as the program and intake coordinator for the Capital Pathways program. I have a professional background in economic development, small business support, and access to finance projects both domestically and internationally. Our session today will consist of a 60-minute presentation. Again, please feel free to ask any questions throughout the presentation via the Q&A function. We'll respond to them as we go. Any questions that we can't respond to in this webinar, we're happy to address through our no-cost one-on-one services or connect you to resources that can help. We'll share a recording of this webinar in a follow-up email. Now I'll pass things over to Rashard to introduce himself, tell us a bit about his background, and start the presentation.
Allie, thank you so much. Virginia, good afternoon. Good afternoon, good afternoon. Before I get started, I'm gonna have my colleagues, Jabari Grant and Courtney Davis, give you guys a quick intro of who they are. And then from there, I will proceed.
Good morning. My name is Jabari Grant. I'm the Senior Vice President, Business Community Manager out in Los Angeles, California. While it's afternoon for you, it is the morning for me. So we are barely having coffee while you're having lunch, but that's okay. We just want to first express our deep appreciation and thanks for allowing the Virginia SBDC to allow us to serve you all. Rashard has a great presentation in store for you. Please do not hold back any questions that you may have. And Courtney Davis and I will be here to monitor the chat so that if any of you have any interim questions that you'd like addressed to the group, please place them in the chat and we'll address them and Rashad will answer them. So thank you again very much and look forward to all your questions.
All right, so thanks again. Good afternoon again, everyone. I'm getting mixed up because Jabari is saying good morning and then I'm saying good afternoon. My name is Courtney Davis and I'm located in New York City. It's 43 degrees today and I'm feeling so great just being able to be on this call to support my colleague Rashard. Of course, I've been in the banking industry for over 25 years. I've traversed retail, commercial, community banking. So I have a wealth of experience and no doubt I'm going to be here to help to support Rashard and make sure that all your questions, as Jabari said, are answered. So thank you again. I really do appreciate the opportunity.
You guys are the best. I appreciate you. So again, I'm Rashad Todd, Vice President, also Business Community Manager with State National Bank. I do oversee the DMV, which is DC, Maryland, Virginia. And again, I want to give a huge thank you to the Virginia SBDC for allowing myself and my team to present today. And Virginia, I understand that today is Thursday and the next 2-3 days, we have a big snowstorm coming. So please, if you can get to the store, get some food, get some supplies, and stay warm and stay safe. But before I jump in, let me say this as a friend. Today, I'm going to pretty much cover, I'm going to have this PowerPoint tailored around startups and the early stage business. Because I get the early stage run. And the big reason is because I watched it up close. I watched my mom grow her daycare from the ground up. And I watched her run into every kind of adversity you could think of. From cash flow stress, unexpected expenses, late payments, also licensing, the compliance headaches, staffing issues, and moments where it felt like one more problem can knock everything over. So when I talk about capital, I'm not talking from a place of theory. I understand what it feels like to have, real demand and still feel that squeeze because, again, the bills show up on time and the money doesn't always. And when you go look for funding, it can get even more frustrating because you have the person who says yes the fastest are often the one with the highest cost of funds, the kind that can trap you in payments and drain your cash flow before you can get your feet under you. So Today, my goal is very simple. I'm going to break down how lenders really think, what you need to have ready as a startup and an early stage business, and where you can go for capital in a smart way. I want you to leave this session feeling clear, confident, and protected with a plan you can actually use. Let's get started onto the first slide. As you can see, we have this first slide. It has on the left the story, and on the right side is your financial performance. With this slide, I'm going to cover how a bank evaluates, again, an early stage business, and we're going to again look through these two windows I just discussed. And let's be very clear. For startups, your story is not a pitch deck. Your story is your business plan, and your financial performance is supported by your pro forma, which is also your projections. Those two documents do a lot of the heavy lifting when you don't have years of business history. So on the story slide, it lists a few things, and I'm going to translate each one into what I'm actually looking for in your business plan. Get started. The first one says how your business started. When you're structuring your business plan, this should be your executive summary. And it should pretty much highlight and break down what problems you are solving, who exactly are you solving it for, what do you sell, make sure it's simple and measurable. Because if I read this and I don't know who you pays or who pays you, the long conversation is already behind. Now let's get into management experience. This would be your team selection of your plan. For startups, that should be your operator. It matters the most. And I'm asking, do you have the background to execute what you're planning? Or do you have someone around you who do? If your plan says you're going to scale, I need to see the leadership that can manage the growth. Third would be your operations. This is your operating plan. How do you deliver your product and services? How do you fulfill your orders? How do you price? What system do you use? What will break if your value or your sales double? Banks don't just fund your ideas. We fund your business plan that you can pretty much execute. Your business plan has to show that the business can actually run. Fourth would be your plans and your objectives. This is where your plan becomes a timeline or like a milestone. You want to break down and explain in detail what are the next 3, 6, 12 months milestones you want to hit, like revenue targets, customer targets, any hiring plans, equipment, marketing, and this should exactly match your projections or your pro forma. For example, if your plan says you're going to hire in 4 months, then your projection should show payroll expense starting in month 4. Another example should be if your plan says you're going to buy equipment, make sure your projections or your pro forma should show the cost and the impact on cash. Lastly is competitor intelligence. This is your market awareness. Be able to explain who else serving your customer, what makes you different, and why the customer have chose you and why they're going to choose you. This matters because your projections have to be believable in the real world. A bank wants to see that you understand your space and you are building numbers you're not building numbers in a vacuum. So that's the story window. Now, again, startups, once again, your story is your business plan. It tells myself, it tells my colleagues, it tells bank employees what you're building, how it runs, and what milestones you are targeting within that time frame. Let's jump over to the financial performance. And I want to say every lender has industries that they lean into, some they limit, and it's not personal. It's just what banks like to call risk management. So the first filter is whether your business model fits the bank's appetite. Now, every bank still anchors their decisions on the 5 C's of credit. And the first C I'm going to talk about is character. Now, with character focuses primarily on your personal financial history and your personal payment behavior. This is huge. It's a huge highlight. Even if the loan is for your business, most banks require a personal guarantee. So your personal credit score becomes your character indicator. Some common mistakes would be late payments, and to fix that, you should have your payments paid automatically. The second C would be capacity. Capacity is your ability to repay from any ongoing cash flow, not just from revenue alone. A business can be busy and still not be profitable. The third C is capital. Capital is pretty much the money you have invested in your own company. Fourth is collateral. Collateral is the access that's securing the loan. And 5 is conditions. Conditions relate to your industry. For example, any economic trends, any customer concentrations, and once again, the appetite of the bank. Now, before I move forward to the next slide, do you have any questions that we can discuss in the chat? And I'll pause for a brief moment.
I'm not seeing any questions in our Q&A session or feature yet.
Okay. Thank you so much. And I'll move forward to our next slide, and that should be, when should you seek financing? I tell my client you think about financing the same way you think about building a strong foundation for your business. You do not wait until the roof is leaking to buy the materials. You secure the resources while things are, stable, predictable, and moving in the right direction. So the best time to seek financing is when your financials/projections look the strongest. Banks reward consistency. When your revenue is steady, your profit margins look healthy, and your cash flow is predictable. That's your window to lock in any credit capacity. Another principle I tell my clients is timing your financing around your long-term goals rather than your short-term pressures. If you know that growth is on the horizon, prepare for it early. So we all know that expansion requires capital, and the businesses that plan ahead most likely experience smoother scaling, a lot of times better pricing, and fewer interruptions in their business operations. Now, some of the common misses, too many owners wait until they're under pressure, and by that time, payroll is tight. If they have any account receivables, they're late, or they're missing a big opportunity that requires fast capital. The financials often do not reflect the strength of the business, and stress shows up in numbers. And lenders, we evaluate numbers in real time. And at that point, you're asking for credit from a position of weakness instead of a position of strength. So for this slide, the takeaway is very simple. I would say do not wait until there is pressure on your cash flow. You should always seek financing when you are strong, and plan ahead while you still have options, because the strongest companies are not just profitable, they are prepared. And once again, I will take a quick pause with any questions in the chat before I move forward.
No, Rashard, you have no questions in the chat.
Okay, thank you. Now, this next slide is a slide that I think everyone's going to love. So let's talk about something that can have starters in a lot of pain, and that is choosing the right type of financing. And you want to make sure that the right type of financing matches the right job. Because one of the fastest ways to get in trouble early is using the wrong money for the wrong purpose. It's like using your credit card to buy a building. You might can do it, but you're going to feel that later in your cash flow. So let's get into short-term financing. Short-term financing, this is the money you expect to use and convert back into cash in less than 12 months. This usually covers day-to-day needs that keep your business moving, things like payroll, your monthly operating costs, any vendor payments, marketing, spend, or the gap between when you pay expenses and when your customer finally pays you. Now, for startups, this is very common because, as we all know, cash flow isn't always never perfect in the beginning. Now, to fix that, we usually like to pair short-term needs with a line of credit or a commercial credit card. A line of credit is best because when you need flexibility, especially when cash comes in unevenly, you can draw when you need it and pay it down when the cash comes in. For the commercial credit card, it is useful for smaller recurring expenses, and it can help you build business credit, but it needs discipline. The goal is to use it for convenience and control, not to silently fund your losses. So again, I tell my clients, short-term money should support short-term needs. If you need short-term credit to fund long-term assets, your product will never come down, and lenders read that as stress. And let's get into long-term financing. Long-term financing is anything you are using for longer than 12 months. Usually what we call fixed assets. This is for bigger moves like if you're going to buy any real estate, any equipment, fund any business expansion that's going to pay you back over time, not instantly. Typically, we pair these with long-term needs such as a term loan, or if you're buying a property, some kind of commercial real estate financing. Now, a term loan will spread the cost over time so your cash flow can breathe while the asset increase in value. Now, when it comes to commercial real estate financing, the structure for the property, because you want to have that asset life as long as possible, and you want to have your repayment terms to match it, so your P&I interest are the same. You're not just paying the interest on the property or the term loan, and you're just paying the interest, not the principal at the same time. That's the main difference between short-term financing and long-term financing. Now, let's get into what we actually came here to learn, and that is going to be where to go if you're a startup or early stage business, where to go to seek the capital. First, I would say let's get into a business credit card. You want to also open up a really basic business banking checking account. For many startup businesses, your first real product is going to be your business credit card and a solid business checking account. It's not small. It just helps you separate your business from personal. It builds banking history, and it allows you to create clean banking records with lenders like to see later. The second, I would say, look into a CDFI. If you're early and you need working capital or a small term loan, CDFIs are often one of the best starting points. They are built for businesses that are still maturing and growing. They may look at your plan and your projections and your management story a bit more than a bank would do at that stage. And also, many offers coaching so your numbers and documents get stronger. The third option is look into SBA-backed loans. SBA-backed loans can support working capital, equipment, and sometimes they can fund business expansions. The key is you still need a strong business plan and solid projections and clean documents. The SBA is not free money. It's structured lending with with some guardrails, but it can be a great bridge into larger capital down the road. Now, a fourth option that everyone is most common with is going to your local bank or credit union. And usually banks become a stronger option when you have the financial statements that show the consistency, deposits that show cash flow that's predictable, and you can demonstrate repayment capacity. Even if you're still early, a lot of banks do lend to startups, but the more prepared you are, the more likely the bank can structure something that fits. Now, one thing you want to avoid all of those predatory lending. When you're a startup or you're in your first 2 years of your business, you are a target to these loans. If someone promises instant money with no documents, I want you to hear alarms going off in your head. Now, here are some common predatory traps. A high interest short-term loan that renews every few months. Those will keep you stuck. Another one would be any daily or weekly repayment products. Those would drain your cash flow quickly. Another big one is these MCA loans, and that stands for Merchant Cash Advances. Now, they look easy, but they can quietly carry very expensive costs. Anything that says approval in minutes offers, don't do it. And lastly, I want to get into one resource that's not really talked about as much. In my opinion, it's very overlooked. And for startups, it can be a huge help. And that is your local economic development office. Every city, county, and region has some version of an economic development department. And their job is very simple. They are only there to help businesses start, grow, stay, and hire within their community. So if you are a startup and you're trying to figure out capital, don't always think banks first. Think ecosystem. Because here's what they can do for you. If you go to your local economic development center, first they can pretty much connect you with local CDFIs, and microloan programs, and lenders that can actually fund startup companies. Like, again, if your bank is not the right fit, they can point you to programs that are built for startups. Second, they can put you in the right lane or into technical assistance that can make you fundable. A lot of counties partner with Virginia or DC SBDCs or any nonprofit businesses that can coach you, that can tighten your business plan and have your projections more clean and get your documents ready. That matters because as a startup, again, your business plan and your projections are your main proof. Thirdly, they can also help you with incentives or grants, and that can reduce your need for any expensive debt we discussed earlier. They can provide you with workforce grants, any hiring incentives, any training reimbursements, any relocation supports, and sometimes they may have programs that fit your industry. Now, not every business qualifies for everything, but you won't know unless you ask. And even when it's not cash in hand, those programs can reduce your costs, what can over time improve your cash flow and make lenders more comfortable. Fourth, they can also help you find procurement opportunities. Some offices that I know help small businesses get certified. They get into some supplier networks, and they can also connect you with, governments and commercial or anchor contracts. And contracts, especially signed contracts, will make your projections a lot stronger and a lot believable, and sometimes can assist your financing conversations and make it easier in the future. Lastly, they can help you pick the right location by avoiding any expensive mistakes, such as we know on zoning, any permits, any site selections, and again, timing matters. But for many startups, that one long lease or one wrong build out can set you back for a year or sometimes 2 or 3 years. I know a client, they were doing a build out for their business and they made the wrong location selection, and let's just say they had an overhead of rent that was costing them a little bit over $250,000 a year, and they had to downsize going into year two, and that slowed a lot of their cash flow and their business growth. Now, again, these economic development centers or offices are not just for big companies. They are a front door for startups to get connected to capital programs, coaching, incentives, and most importantly, especially in the DMV area, any contracting opportunities. So I'm going to pause for a quick second, go move forward. The next slide.
No, you currently have no questions for sure.
Okay. The sixth slide should be about cash management. I'm going to cover that following slide for the same thing. All right. Now let's get into the part that divides whether a startup survives long enough to scale, and in my opinion, that is cash management. Now, a lot of owners hear cash management and they think cash management is just checking their bank balance. It's not. Cash management is how you control the timing of money coming in and money going out, so you can operate smoothly and avoid panic decisions. Now, this slide, it really shows 3 gears on working together. That is your AP, which is your account payables, and you have your ACH, direct payment, payroll services, commercial credit card, and fraud protection. And that would turn into the efficiency like time savings and automation, and safeguards, and those will turn into your account receivables, which is your lockbox and your merchant services. Now, let's get into one of the most important slides in this PowerPoint, and that is your business ecosystem. One of the most important people in your business banking journey will be your banking advisor at your current bank. A lot of times that would be your business banking relationship manager. Every business account has a business banking RM assigned to them. And sometimes I understand if you are banking at these larger institutions and your account balance is so small, or you're a startup, or you're not really showing that much deposit inflow to the bank, you may not receive a call from your BBRM. You may think your branch manager or person in your local branch is your banker, and that's not true. Your business banker is the person who's your main advocate at your current bank when it comes to capital and just capital, and also for cash management. Secondly, let's get into your bookkeeper or your CPA. Your bookkeeper or CPA, keeps your business honest. They support your accounting and your financials. For early stage companies, this is important because lenders rely on clean reporting. Now, a bookkeeper or a CPA can also help you stay consistent with practices. They help you avoid co-mingling accounts and missing tax filings, or having numbers that shift every time you open your spreadsheet. A lot of business owners use QuickBooks, and sometimes you may use it the wrong way. You may not understand if your business is accrual or is it a cash basis business. And when you provide those documents to the bank and your numbers are not reflecting your numbers, it can make the financing conversation a lot harder down the road, or you may get more declines in approvals. Third would be having a business strategy. I tell my clients you want to have some kind of coach outside of the bank, like somebody at the SBDC, some kind of business advisor that can help you stay focused, someone you trust. You want their role to be defining your goals, setting targets, and help you develop a plan that you both can execute. A lot of startups don't just fail because they lack capital. They fail because sometimes they lack focus and they lack discipline. And I understand that can be hard because, as we all know, in those first 2, 3 years, you may be showing a negative net income, losing money. You're wearing 1,000 hats, so many phone calls, so many boots on the ground, and it just can be overwhelming. And I understand that, but you gotta stay focused and you gotta stay disciplined. You gotta overcome the storm because over the horizon is something beautiful. And I watch so many clients fight the uphill battle to go from revenue size at low 6 figures or sometimes no money at all to producing 7 to 8 figures in revenue. Lastly is one of the most important things on this slide. That is a periodic assessment. All that means is you want to have regularly step backs and ask, is my current plan working? Are we hitting targets? Is the business assumption still true? And do we need to pivot, such as adjust the pricing, change any offers, or change how we spend? When it comes to changes, a lot of times people look at changes as it's scary, but change is good. You want to grow with your business, grow with the economy, and grow with your consumers and your customers. And you don't want to be left behind. So you should be having these assessments. It can be monthly, it can be quarterly, it can be at the end of every fiscal year. Whenever you decide to have it, make sure you're having it as one of your business strategies. And when it comes to lenders, we love it because we look at the operator as being someone who can manage their business the correct way. They're not just going into this business for the wrong reason. They're actually trying to grow their business for the long term. We can see their steps. That's why having BBRM is so important because that BBRM has to understand your business and your personal goals, whether it's short term or long term. Once your banker understands that, and treat your banker like your attorney, don't lie to them. Tell them everything up front. Because the more they understand about your business and yourself, the better they can be your advocate when it comes to underwriting. Banking is about relationships. Of course, credit matters, things like that, but a lot of times to get over the extra hump, banking relationships can play a part in whether you have a good banking experience or one that you may be currently experiencing right now. So I want to also say 2 things. If your current bank does not have not assigned you or you have not got that email or your phone call from your BBRM, because their main job is to check in with all their clients, whether it's quarterly, monthly, or bi-annually. If they have not given you a call just yet, he or she, you should change banks. If your current institution does not have an appetite for your industry, you should change banks. You should go to a bank that values your industry and value you as a customer, and they give you all resources up front to make you have a good banking experience and to be the passenger in your business so you guys can grow together. And that's the end of my PowerPoint today. We'll get into Q&A with my colleagues in 1 second. But again, I want to thank everyone that came out today. I understand that again, we have a huge snowstorm coming in a few days, but you guys came on this Thursday afternoon, and I appreciate that. To sit down, hear me and my colleagues speak. So please, any questions you have, throw it in the Q&A. There's no such thing as a bad question or dumb question. Just take advantage of this time. We might have maybe 30 minutes left, but please, any questions, put it in the Q&A.
So we do have 2 questions. First one is, where can I find information about the local economical center?
That is a great question, Carlos. So usually go into Google, you can ask somebody at the SBDC, like Linda and her staff, where's my local county or local center, economic development center, and where it's located, we're going to talk to you. And someone at the SBDC should be able to put you in contact with somebody over there. Or you can just Google it. Type in, if you're in Loudoun County, type in Loudoun County Economic Development Center, and a lot of times it'll pop up. And then You just call a number on the contact list and go from there.
Thank you. Next question is, if operating at a loss due to operating costs, but meeting the forecasting goals, do you believe a lender will still consider providing a loan?
Yeah, Bobby, great question. I really love him. That goes back into using your BBRM and having one at your disposal, because if he or she understands your business, again, they can pretty much be the advocate to underwriting, and they can explain any bumps in the road are not permanent. A lot of businesses operate at an operating loss, but there's reasons why that could happen. As long as it's not on like a trend, as in you're losing money for the last 5 years, it was a one-off, we can explain that. If you might have had an expense this year for marketing, for a random roof leak, we can explain that. But if we do the operating costs,
Yeah, and it's also important to just to understand that the baker understands the story. So if you do have an operating loss, however, things are turning around for you and you are hitting your forecasted projections, then there are lenders out there that can still assist. Some of the CDCs and the CDFIs that Rashard spoke about do lend on a projection basis. As long as there's a strong credit profile in place. So absolutely, there is still programs out there that can still assist, as long as you have a sound business model. Again, the key to that is making sure that you do have that business bank relationship manager that has strategic partners in the fields, such as the Virginia SBDC and other lenders that can assist and help you when your business is in that situation. But again, it does come down to the relationship piece and making sure that the relationship manager is not only a consultant for you, but an advocate, so that they want to see your business win. So when you are in those spaces where you have some net operating losses, that you have someone you can talk to with confidence that will help you find solutions.
thank you, Jabari. One more question. If requesting a first-time loan for a new business and have a business plan, do you see a lender needing a PowerPoint, financial presentation, or just a written business plan? So when it comes to get business plan, it can vary by lender, but most likely they want to see your business plan in a Word document, because they have to be very detailed, different selections go from, again, I discussed earlier, your first page should be your executive summary. That's your story. And you want to break down everything from that point on. So put it into a Word document. And then when it comes to your projections or your pro forma, you want to have that on some kind of spreadsheet. Now, for the first year, you want to have that month to month. Month 1, month 2, month 3, month 4, month 5. Once you get past month 12, you should have it on an annual column. Year 2, year 3, year 4, year 5, and break down everything from your revenue to your expenses in that spreadsheet.
Thank you.
This is a question.
Yep. So I have another question. If someone just started a business and need information on how to go forward, where should they go besides the SBDC?
It's a great question. You have so many resources in front of you. The SBDC would be a great one because they have a huge network. You can lean into your economic development center. Again, a huge network. Go into a bank and talk to a branch manager or a branch employee. You want to go somewhere that can utilize their network and resources and get you what you need to move forward. A lot of times going to SBDC is a lot better because their main job is to assist the business owner to move forward with their business and put them in the right situation to be successful.
Thank you. So next question. Where should a startup business with no existing revenue start as it relates to securing funding?
Where should a startup business Sorry.
Yeah, that's a great question. So when it comes to startups that have no existing revenue, it can be very difficult to find financing from your traditional sources, such as banks or even, SBA lenders. But if you have no existing revenue whatsoever, there's going to be two options usually for startups in that case. One, you're either going to have some find seed capital, private equity dollars, or venture capital money. So when you are in the private sector seeking financing, a few recommendations that we often make is make sure you find a private equity firm or venture capitalist that has experience in your industry, first of all, but also make sure the strengths of that lender or that investor, I should say, can offset your weaknesses. So, for example, if you are strong in marketing, but weak in accounting or weak in another area, make sure that venture capitalist or that investor can offset your weaknesses so that you can have two partners that have two strengths in the business. But brand new businesses with zero revenue can also, maybe a 7A loan on a projection basis can also assist in that way too. So there are still some options. However, you're still going to have to demonstrate to the lender a way that you can service the debt, even on a projection basis, whether that's from, maybe you're still working a job while you start the business. But typically, startups with zero revenue and minimal experience or exposure to the industry is going to be leaning mostly on investors and private equity funds.
Thank you, Jabari. There's a question from Mr. Bobby. Most startups do not have a person with management experience in that field. What is your recommendation in a startup funding one as such? This seems to be a recommendation for lenders, hence the reason I asked this question. That's a great question, Bobby. A great question. I love that. Banks are in the game of risk management and pretty much just, I'll be frankly, repayment. You want to have an operator or a business owner that understand the market they're going into with great detail because, again, banks are into risk management. Now, you can hire a staff around you that may have 1 year or 2 years that understands this field you're going to. You guys can come together and move forward. But having somebody in your business, such as the operator or your staff, not having no experience in this market, funding can be difficult because even that CDFIs, SBDCs, or 7A loans with SBA, you're going to have to explain your management experience in your business plan with great detail. And you have to explain your market and why you chose that market and why this market fits your business plan to a T, and how you're going to conquer this market. And I hope that answered your question, Bobby.
Thank you. So the next question is, for someone not approved for a loan in the state that they're based in, can they apply for a loan in another state?
If the lender has an appetite for doing loans outside of their footprint, then yes, there are some national lenders, that will lend in multiple jurisdictions throughout the nation. Again, it's just important to find those resources through, partners such as the Virginia SBDC, your local business banker who may have, again, access to strategic partners in other locations. But yes, there are some lenders that do lend outside their footprint.
And can I just add something to that,
Yes,
Jabari?
please.
Hello? Can I just add something to that? And, in just asking the question, it kind of leads me to something that I think Rashad touched on a little while earlier. It's easy for us whenever we don't have access to capital to jump at the first person who offers us capital. But what I'll just say is, we want to be very, very careful. For example, there are some lenders around who are merchant lenders, who are lenders who are really have some real high interest rate loans. And it's easy to go out there and, just enter into agreement with them. And one of the things I want to, caution everyone, every small business owner on the line is just to be careful that, in your pursuit of capital, that you do not take loans that are those high interest loans that are really going to wreck your business, because you're going to be back at point zero if you take a loan that is paying, some of these merchant loans, some of their interest rates are like 40 and 50%. And, it's hard when you're starting out to take those loans and keep your business viable. So, I just thought I'd just share that, since, we're talking about access and being able to get loan for startup.
Thank you, Courtney. I want to touch on one more thing that I don't think I touched on in the PowerPoint. I was most focused on startup businesses. But when you're applying for capital and you might have 1 or 2 years of tax returns, as the owner, you want to pay yourself. Pay yourself some kind of salary at the business because you got to show personal cash flow. Your business has the cash flow, and then personally, you have the cash flow as well. Every bank has a benchmark when it comes to the business cash flow. It's called a DSCR. That is your debt service coverage ratio. Banks want this to be at a 1.25 times. The SBA, I believe, is 1.15 times. And that is your business cash flow. Look at it like your personal DTI. Also, you have a personal and they combined it, and that's your global cash flow. So if you're not paying yourself from your business or taking out any distributions that's on your return that the underwriter can see as a form of payment to yourself. In small business lending, financing may be difficult depending on the lender you choose or where you're going. But paying yourself is important when you're in those early stages in your company. Or I'm sorry, if you still have a W-2, that's perfect, but you have to have some kind of personal income as well when you're applying for business financing. Have any more questions?
Not at this point. Oh, one just came in. What is your recommendation when it comes to lenders for businesses that solely operate online?
Can we have Bobby come on for a second? Can we have Bobby unmute himself? Because I want to ask him, is it an e-commerce business? What kind of business operates online? If he doesn't mind.
Give me 1 second to... Bobby should be able to unmute.
How you doing, Bobby?
Hey, how's it going?
Good, and yourself?
Doing well. Yeah, I appreciate you answering my questions first off. But in regards to your last question to me there, it's more so for an e-commerce store that I have. So it's a group of us, three, pretty much running this e-commerce store, and so it's all online, no physical presence in the area, so hence the reason all the questions. So in my previous engagement or in a similar meeting as such, I was told that an entity operating online has few options. So I was curious if you had any ideas of, any options or any other options for someone that operates online.
I do. It goes back into finding an institution that has an appetite for e-commerce businesses. Now, like you said, one of the main issues is not having a physical location. Some banks are okay with having a virtual address. Some banks are okay with having executive suites. But you want to find and shop around and see if this institution has an appetite for e-commerce businesses. And like I said earlier, banks are in the game of risk management. So you may have to go to like a small community bank, a small regional bank, and sit down and really discuss with the branch manager or the BBRM and give them your idea, so your business plan and what you guys actually doing on this e-commerce site, and then ask them, frankly, do you guys have an appetite for this industry? That can save you a lot of wasted shopping around, getting these hard no's. I'll let my colleagues answer this question as well if you have anything else they have for input.
Yeah, Bobby, typically an e-commerce business, especially one that sells products either on a wholesale or retail level, can still be treated as such, whether it's virtual or in person. And if it's a home-based business, many small businesses are home-based businesses that have a quality web presence are absolutely lendable entities. So yeah, there are a number of lenders that would absolutely lend to you on a working capital basis to help you with the inventory or cash management. So yeah, if you run into that issue where lenders are telling you no, again, I think to Rashard's point is again continue to shop around and find a bank that has an appetite for what you do. But there are quite a few lenders, not just a handful, but quite a few who would absolutely lend to a successful e-commerce business.
Thank you, Jabari.
Thank you guys. Appreciate it.
Sorry about I'm
Thanks,
sorry.
Daniel. So it looks like we have one more question or a couple more questions coming in.
Beautiful.
First one is, what would you recommend? Going through SBA or a bank for the purchase of an office building?
Ooh, great question. Great question. I like both. That from Miss Kathy. Miss Kathy, again, wonderful question. Thank you for asking this question. Great question. With the SBA, you have options like the 504 loan. With the banks, you have some form of CRA investing. Which other one fits your how can I put it? Fits your
I would
the
say, yeah, your liquidity needs. Yeah,
is all your personal choice.
yeah. So I think that is a wonderful question. Sorry, Rashad, I didn't mean to cut you off. A few things you want to consider when either choosing to go SBA or go traditional financing. The SBA, of course, is going to give you more flexible down payment options. So if you have limited capital, and you don't want to make a larger down payment on a traditional loan structure, then you can use the SBA, which will allow you to put 10% and in some special cases, 5% down on a property. However, there are going to be additional fees and costs that come with an SBA loan because you have to pay for the SBA guarantee. So although it gives you less introduction costs or less initial cash outlay, there are additional costs that are financed into the loan. However, if you go traditional, maybe straight to a bank or your banker, well, then you may have to come with a larger down payment that are going to require a 25% down payment. However, there won't be any addition. The cost will be lower for the loan because there's no SBA guarantee fees wrapped up in a traditional loan. So it comes down to what your current financial status is, what your balance sheet looks like. And so that it's important to get that consultation from your business bank relationship manager so you guys can converse about, hey, are we in a good position to put more money down? Is it going to impact our cash flow? Is it going to impact business operations? Or do I need tenant improvements when I acquire the office? Am I going to need to make a number of improvements to the building? If so, it may be better for you to go with the SBA loan because you can build in those costs of the improvements that need to be made on the building inside the loan. So again, it's all dependent upon one, what the needs are post acquisition of the building, and two, what the needs are from a liquidity standpoint on the balance sheet. But again, the consultants at the SBDC and us with the Ladder Up program are all willing to give you some consultation in those areas. But great question.
Thank you, Jabari. And I'm gonna give you two more like golden nuggets outside of the SBA and banks as well. When it comes to real estate, you can also look into a couple life insurance companies as well. They can lend for CRE. It depends on the property type and your experience as an investor. Secondly, I'm not sure about Virginia, but I know in Maryland, the Maryland Law Casino has to deposit their proceeds into a fund, and that fund is allocated towards small businesses for real estate, for capital, whatever it is. It's always other options to get financing for whatever you need. But again, just weigh your options, talk to the consultants, talk to my colleague just said by SBDC, and exhaust all your resources before you choose one.
Thank you, gentlemen. All right, so we have two more questions and we are at 1 o'clock. So I think we will call it after these two.
Okay.
First question is for someone trying to start a laundromat service. Do you recommend an SBA loan like a 7A or another option?
I love these questions. I love the startup questions very much. That's why I tailor my PowerPoint for this exactly. When it comes to choosing a 7A loan, like my colleague Jabari stated earlier with Kathy's question, your equity injection is a lot smaller. A lot of times, SBA backs these loans and has a loan guarantee for the lender. So if you're going to choose that, and quick question, are you going to acquire just the business or the business and the real estate? That matters into what loan you go into as well. So can we have Ms. Davis if she doesn't mind? Both? Okay. So yeah, the SBA 7A could be a good choice. Again, just weigh your options, make sure that the cost up front and the cost in the back end makes sense to you. I'm at my colleague, Courtney Davis with Barry as well answer this question, but in my opinion, I think going a 7A route is a smart choice. Or look into, again, it depends on the upfront cost. You got TFIs who might lend up to 250, 350, depends on what the cost is up front. But a lot of times 7A loans are these back government guarantee loans with a lender, and laundromat services, depending on the location of the laundromat, and it was an existing business and the finances make sense, you could have an easier route.
Yeah, I would certainly, for business acquisition, I would take a really close look at the SBA 7A. That is a prime product for business acquisition. One, it does allow you to get in with minimal cash injection. Also, it takes into account some of the cost of building even the entity that you need to acquire the location. So any monies that you pour into that business acquisition, the SBA will consider as your portion of the cash injection. So you can walk into a business with as little as 10 to 15% down on that company. And then as you grow the company and allow it to get on its feet, you can take any cash you were able to retain by using the SBA to inject into business. So I would certainly, for business acquisition, the SBA 7A would definitely be my first choice unless you have a lot of liquidity and liquidity is not an issue for you, then you could go into it on a traditional basis. But for the most part, banks are going to like the 7A structure because it gives the bank a government guarantee on the money you're borrowing. So that way, you're not collateralizing maybe your home. You're not having to collateralize all the assets in the business. So the SBA 7A would be my first recommendation to look at for business acquisition.
I think I would also say the same thing too. I think coupled with that too is some banks are, because laundromat tend to be a cash business. Some banks don't like to go at that type of business alone. So doing it with like a 7A would be more, because there's a guarantee involved, would be more up the alley of most banks. So I definitely agree with you, both Rashad and Jabari.
Thank you, gentlemen. All right, for our last question, rather, the person is seeking a loan for building 4 homes on their property. The homes are being built to rent to homeless VA men and women. The question asker has excellent relationship with their banks. However, they've been informed that they do not offer construction loans. They are presently working with SBA in Georgia. What are your thoughts on getting a loan from brokers?
That's a great question. You want to do your background on these brokers and make sure that whoever they are credible. And make sure that the upfront cost is made. Because if you're doing construction to perm, all that means is a construction to permanent mortgage. You want to make sure that the structure of this loan it makes sense, because a lot of times you may get into a multi-disbursement loan when doing this structure, and they're going to disperse the funds based on the project phases. When it comes to brokers, you want to be mindful of the broker fee if they have a broker fee. The brokers are also in the game of getting paid as well, so be mindful who they refer you to. A lot of times they may refer you to the best person for them and their needs, and not necessarily for you as the customer. So to do your homework on the broker and make sure that the upstart fees and the transfer fee or broker fee is feasible for you as the customer, and make sure that the loan that you're being structured with from that broker referral is a construction of perm, and the loan is a multi-disbursement loan, or it can be a monitor loan, which is the same as that thing, depends on the lender, how they word it, and all that makes sense for you moving forward.
Yeah, I would say if you have an avenue with the SBA to stay with that avenue if at all possible, and if they're providing enough lending capacity for you to complete your project, then I think that's a very safe structure for you. You can go into the broker world. However, again, be mindful of excessive points, excessive costs, excessive fees, and predatory rate loans, especially when it relates to construction, because, as you know, construction, what they call overruns, or when the costs go a little bit higher than a few $1,000s more than you had projected, you could get easily into a cash crunch and find yourself in some trouble. I think the SBA does a very good job at, one, keeping you in the parameters and making sure that they cover for those overages without the exorbitant broker points that are going to be added to the financing costs. So again, I would just be mindful, and if possible, stay with the SBA as much as possible, as much as you can. Not saying there are not brokers out there that find good products and good programs, but it can tend to be a little pricey when you start to include brokers, especially if they know that you're in a tough spot to get a tough, complex deal done. I hope that answers your question.
Thank you, Jabari. And thank you, everyone on our panel, for joining us today and answering all of these great questions. Rashard, thank you for the presentation. It had some excellent information for our participants. We definitely look forward to future sessions with you guys. So with that said, our time together has come to a close. And the recording of today's session will be shared as part of a follow-up email that will be sent to all participants within a week of this webinar. If you're interested in getting started with Capital Pathways, I've dropped that information in the chat. Please feel free to reach out to me either through our website or directly through my email. If we weren't able to respond to your questions, please send us an appointment request and through our website or my email, and we'll be sure to connect you to resources that can support your business needs. Thank you so much, everyone, and have a wonderful day. We hope to see you in future webinars.
Have a nice day, guys.
Great day.